Welcome back to Central Valley Talk. We are talking to people lately about investments, about money, how to keep your money, how not to lose your money. It's so complicated. I just don't know that much about it. But we have an expert that comes on the show about once a month or so, and his name is John Grace. Welcome, John.
Thank you, my friend. Good to see you.
Last time it was just fascinating because you said sometimes it's about knowing when not to lose your money.
Yes.
But most of our viewers aren't big investors or really rich people or people with a lot of money. They're just Joe Sixpack who wants to kind of set something up for the future so when they get to their later days that they're secure and safe. Where do we start, John?
Well, we've talked a lot, Mike, about doing what you can to limit your losses. I've only been in the securities industry since 1979, and frankly, we sound the same today as we did 44 years ago, 45 years ago. Stocks for the long haul, hold and hope, sit and take it, buy the dips. It's not timing, it's time in the market, okay? Have a long-term view. But here's the thing. That makes all the sense in the world, particularly when you don't need the money or you have a lot of time to recover, all right? And let's just recognize that many of your investors, our friends, our family, and whatnot, whether we had a lot or a little, you went through not one but two 50% losses in the same darn decade. Now, if you're making contributions, that's a wonderful thing. But if you're taking withdrawals, it's not so pretty. This plane's coming down hard. And I mean, it doesn't matter if you're taking withdrawals that you want to take or you must take because the majority of the money is in traditional retirement accounts, where, as you know, the Internal Revenue Service requires you to take withdrawals. And wait, there's more. Every year, regardless of what happens to your account value, that withdrawal rate goes up a little bit. And yes, it's always taxable, and no, there's nothing you can do about that. So what can we do to limit our losses is the real question, as opposed to, in my opinion, my friend, telling people you have to live with the losses. That's an insult. I mean, the truth is, 40 years ago, it was the truth, no matter what. The good news is, just like cars, a lot of things have changed. There have been a lot of improvements, and still the industry suggests that you're well diversified, 60% stocks, 40% bonds. That's it. That's all, folks, that you're diversified. So to liquid investments, we're showing folks how you might want to look at strategies that move your money off the deck of the Titanic. In other words, if it's in a position where it's well, let's say it's professionally managed, but what that often means is we go from this deck chair bond to that deck chair stock, that bond to the other stock. The chairs are still on the Titanic. So how do we remove the chairs from the Titanic, let the market go to the bottom of the sea, but that doesn't mean it takes your money with it because your money's sitting in cash. So that's step number one. The second one is what we're going to be reviewing on the 6th of September, and your audience is welcome to join us, whether in office or on Zoom, right? And we're calling it, with classes in session, what's the alternative to volatility? That's a good question. That's what the class will be covering. And we're going to be reviewing alternative vehicles. Why is that important? Well, I'm going to submit that when we look at the markets that can just turn upside down in a nanosecond, and some are suggesting, the prognosticators, that we could see a 50 to a 60% loss in real estate and a similar loss, if not worse, in the stock market. How can you keep your assets from being handed to you? How can you keep from being kicked in the assets? So we're going to be looking at a vehicle. What did Warren Buffett say? I think he said two things that were quite meaningful. One, he said if we had limited our losses with Berkshire Hathaway, the $1 trillion market value that he got real close to back in February might be worth $2 trillion because we could have done a better job of limiting our losses. And that's what we're saying to investors. We, as investors and investment advisors, can do a better job by showing folks how to limit their losses. He also suggested that we know what we own. So we're going to be looking at a vehicle where, and there's several out there, where he says, know the companies that you're taking a position in. Don't just throw your money in the dart on a dartboard and hope it goes up and you feel smart, and when it goes down, you don't feel so smart. So what can we do to own a company of companies? And this is there are a couple of them. Some of them are liquid, some of them are illiquid. or you have to have intervals where liquidity is available. But this position that we're going to be talking about on the 6th at noon, that's Friday right after Labor Day, first Friday in September, will be on a vehicle that's been open since 2018. And the interesting thing is, this is a husband and wife team in Beverly Hills. They've been both, Mike, married for 40 years and business partners for 40 years. Now, I don't know about you, but I'm not getting either one of that. Okay,
That's
they got both.
good, yeah.
I'm green with Evie. My goodness, you like each other that much. But they've only been working until 2018 exclusively with endowments, foundations, and like pension
big
funds.
investors.
Huge amounts. I mean, writing checks for $10 million. And the deal was that in 5 years and sometimes 7 years, the institution or the endowment wants the money back. Whatever you've made, that's what we want back. Time's up. You got to get out. So they said, we like the work that we do, and we want to do the same work for retail investors. Let's allow a position where maybe it might become one that we can retain, but this way we can do the same work for ordinary investors who have far less than $10 million. And in some cases, the minimum is you have to have income of $70,000. And
I have far less than
$70,000. Yeah, or $250,000. But, the minimum is all of $5,000. Now, this particular vehicle has held up well since 2018 when we said that we thought it would be recession resistant. Now, you and I remember back in 2018, 2019, nobody was using that terminology. And now still people are afraid to use it like, it's something that's just terrible. Well, it happens. But the question is, how can you keep above the water line? That's the question. So if there's a position where you're getting a yield of, let's say, 3 to 4%, and the return is no less than 10% net to the investor, that will probably work. And that's exactly what this vehicle has done for, what is that now, 6 years or so? Yeah. It will close in October. So we're really, banging the drum saying, hey, folks, take a look at this. It might make sense for you to at least see what else you can do so that if the, grits hit the pan, it doesn't mean that it takes your money down to the bottom of the sea like leaving it on the Titanic.
If I sign up, or one of our viewers signs up for the September 6th, what do you call it, a meeting?
It's a webinar where folks are invited to lunch in our conference room, limited seating, of course. The last time we did one in June, we had like over 50 people on the Zoom call, live on Zoom. Some, interestingly enough, in Australia and Pakistan and the Philippines. I mean, I don't know how that happened, but it's okay. We got room for you. Come on down and let's learn some things that we can apply. And that way we can stay in chips and get to age 100 without trying to, without going through running out of money before we run out of time.
We're going to have to get ready to stay till age 100, I've got a feeling. So you're talking about a vehicle, people could get in for maybe how much? 5,000?
Minimum of 5,000. In this case, there are others that have larger minimums. Some of them, as I say, are liquid. Some of them are illiquid. The one we're talking about on the 6th of September, we call it illiquid because we want people to be in it for probably the next 5 to 7 years. And let's just say hypothetically, in the event that one were to put $20, $40, $100,000 in some position somewhere where the returns were about 10% per year, in 7 years, using the rule of 72, that original investment doubles. Yeah. And that's what we want to see. We want to see, particularly when you have to start taking withdrawals, how can you offset the fees, the taxes, the inflation, as well as the withdrawal rates that the IRS requires you to take money out? How can you have some growth to offset all those other things that just takes away, kind of makes an eraser to the value that you open the accounts with?
I feel like that's the most unknown part, is when you have to start taking it out, what the costs are, what's going to happen. I think people don't even think about that. They get there and all of a sudden they find themselves in the middle of it.
You're spot on. I mean, the CPAs, the accountants, the financial advisors, we all said the same thing. Sink as much money as you possibly can in your 401k. We just happen to leave out, yes, you have to take the money out. Yeah. Yes, you can't avoid withdrawal taxes when you start taking withdrawals. And no one explains to folks that, geez, yeah, it's great. In fact, the value of your account could very well be 30% more because of all the tax-deferred growth that you enjoyed on this money. So that's a wonderful thing. But at some point, the Internal Revenue Service says, nope, well, let's you got to understand, you've crossed this age threshold. Now you must start taking withdrawals, and it may be as little as 3.4%, 4%, something like that. And then we get in our 80s and we discover, oh my goodness, now it's 6%, 7%. Stick around, it's 8%. Ooh, yeah. Now, that's my point, that you can avoid. And then one of my CPA friends calls traditional retirement accounts tax infested investing because we forget to tell people how this is going to turn out. And some people, I mean, they're resentful, right? I don't need the money. I don't want the money. What do you mean I have to take it out? And how come it goes up every year, the withdrawal I have to take, no matter what my account did? It was up 30% in 2022. And you mean I have to increase the withdrawal after the year that it just kicked me in the assets by being off 20 or 30%? Yes.
You know, I got to say, John, they do tell us about it, but our minds elsewhere, our 30s, late 30s, 40s, and they're explaining, hey, when you take it out, this is going to happen. We're just trying to figure out how to get it in and build for our future. And they do I know they explain it because I've heard what you're saying before, but you know, it doesn't click with us until we get there.
Doesn't click because you're not there yet.
Yeah.
But stick around, you know, and you're going to be there. And we don't want you to try to be there and have to think you could qualify to be a Walmart greeter because you're overqualified.
Yeah. Let me ask you, John, this thing on September 6th, who could go to that? Who should go to that? Who should
Anyone
attend?
who wants to know about different ways of investing, all right? Those who, as I say, what's the alternative to volatility? Who knows what the future holds? But rather than try to predict the future, we're going to submit that you want to be prepared for a future that includes uncertainty. And what do we have these days? A lot of volatility. Things can turn around immediately. And then, you know, in some cases, we may see declines that just stay at the bottom of the sea or, you know, in the red for some long period of time. So there's no exact formula, but it's good for people to see that the formula that the securities industry has advocated, 60% stocks, 40% bonds, well, it may work, but it doesn't work all the time. At the same time, it's interesting to recognize endowments like Yale. The Yale endowment, I think, is $40.7 billion the last time I looked, and their exposure to U.S. stocks is all of 3%. That's vastly different than what most of us do.
Yeah.
And most of us get high on whatever it is that's been doing well, whether it's cash or annuities or stocks or bonds or real estate. And what I'm saying is, notice that when it comes to some of these endowments that are very large and they do a lot of things, but their exposure is very low to any one asset class. That's number one. And number two, what I notice is that in many cases, the ratios that they have in as many as 5 or 6 different vehicles, not 2, we can all agree 4 or 5 legs under your portfolio stool is stronger than 2 legs. Right. I think we can agree to that, or 3 legs. But the exposure in some cases is not as high as 20%. So let's just notice, Yale says, this is what we did back in the 80s, 60-40, 40-60, traditional investments. And by the way, if you scour their site, they say they did not lose money in 2008. I can't verify that, but I'm going to believe them. This is good news because the averages come from all kinds of numbers, right? But if they found that that was their case, that was their experience, that's what I'm saying. Let's learn from the best and the brightest, the real smart money, because maybe there's some things we can do like the endowments do. We can't do exactly what they do for a host of reasons, like they don't need 100% liquidity. Investors do. But we can learn from the best and the brightest, reduce our exposure to any one asset class, increase our exposure to more than 2 or 3, and not make big bets, which, of course, is what the majority of us do.
Now, if our viewers are in Westlake Village, they could come to your conference room?
Yes, sir. Happy to have you. As I say, seating is limited. We are taking reservations. They can just email me, jgrace at YBPOR. That's WHYBEPOOR, 3 words all together, spelled out, YBPOR, and we'll be happy to accommodate them. And Mike, you know what I want to also say, appreciate having this conversation. We're encouraging folks to include family, right? It's good to take care of your neighbors. It's good to have a different conversation, particularly with the children. They need to know what you wanted to do, what you were trying to do. And now you have some discussions that can go back and forth in terms of what we're learning, because nobody wants to run out of money before we run out of time.
Yeah, my kids are in their 30s. They ought to attend this as well with me so they know what I'm trying to do.
Exactly,
Yeah.
exactly. And now you have a different conversation. You're not beating them up about something from 10 years ago. And by the way, they're not beating you up either.
Yeah. So I have a web address, westlakefinancialadvisors.com. Can they
Yes, sir.
find out more there?
Yes, absolutely.
And also I put your phone number on there, John, 805-495-2077. Can they sign up there or call there and get signed up?
We can take phone calls, absolutely. Or as I say, email, contact at Investors Advantage. We're happy to fill the room and fill the Zoom room as
Right.
as
And
well.
I was going to say, you don't have to go to Westlake. We're in Northern California, and you could be anywhere in the United States, right?
Yes, or anywhere in the world.
In the world,
right?
that's right.
Yeah, we'll
You
give
said-
you the link. You can sign in, and then we'll take it from there. And if you want to talk more, we're happy to do so.
And you said
we
last
just
time-
want to do what we can to
last
help
time you had some
investors
people-
do a better job.
Yeah, last time you had people zooming in from where? Other countries?
Yeah. Last time it was Australia, Pakistan, and the Philippines, and I was so curious. I'm like, what time is it there? I think in
Yeah.
Pakistan it was 12 o'clock. In the Philippines it was 2 a.m.
Yeah.
Okay, that's fine.
And here
Come
in
on
here in California, it'll be noon.
It'll be 12 to 1 or 1:30 or so.
12
Yes,
to
on
1:30. Good,
Friday,
good.
the 6th of September.
If you're watching this, sign up, get involved, get ahead of yourself. None of us are experts at this stuff like John Grace is. So listen to him. When John Grace talks, people listen. Thank you, John. Last thoughts for our viewers?
Well, this is a time to really kind of measure what you want to look at. What we learn a lot from engineers. So think about what the worst case scenario might be.
Yeah.
If it is the case that for reasons you don't expect, prices when the stock market drops 60, 70%, what can you do in advance so that if that happens, and hopefully it won't, but if it does, you can tell your story because, well, for example, if the market was off 20 to 30% as it was in 2022, and you were off, let's say 7 to 10% hypothetically, what do they say, Mike? If you find yourself in a ditch, stop digging. So if your ditch didn't get any deeper than, let's say 10, but everybody else's, it went down 20 or 30, you see that you can probably recover when the debit, if you will, or the ground that we've broken is not too deep. Once we get 30, 40, 50%, right? We worked with one lady, Mike, her account, her son had us take a look at. She did not recognize in '08 when the market was off 37% and the no-load mutual funds were off about 40, 42%, 2008. Her account, if she had held the same positions on the statement that she provided, were the same in 2008, running it backwards. Her account was off 70%.
Oh, my
that
goodness.
we don't want that to happen
Right.
to anyone ever again.
That's right. All right, so sign up for the seminar September 6th in California around noontime. Get a hold of John Grace and sign up. John, thank you for your time. And for our viewers, we'll be right back with another guest.
Thanks so much, Mike.